lots to talk about. A lot of it's serious. Sometimes we have fun on Saturday mornings, but there is so much information out there, and it's been a wild week. Of course, the tragedy in Afghanistan, and our heart goes out to all of those who have lost their lives. And then we ended the week with a report from the Federal Reserve Chair who doubled down on his transitory talk.
Right. Jerome Powell, very dovish in his comments, music to investors' ear, basically talked about progress on inflation being met, employment gains that are starting to get almost to where their goal is, which is basically back to the pre-pandemic levels. But he's still monitoring the virus and how the country reacts to it and what that says for the labor market. But generally speaking, a very dovish, accommodative report. He also cautioned that even if they begin to taper, that's still accommodative, and that is not linked to interest rate hikes, which is what most investors were pleased to hear.
All right, so let's take that apart. So the taper means that they're going to taper their bond purchases, and if you haven't heard the show, this is where the Federal Reserve goes out and purchases bonds, both Treasury bonds and mortgage-backed, to the tune of $120 billion a month, and that could disrupt pricing. But let's explain what tapering means.
What tapering means is they've decided that some of the preconditions that caused them to do it in the first place are starting to be met. In other words, the economy is on a firmer footing. The credit markets are liquid. There are no issues there, no fear of a lockup in terms of interest rates and liquidity issues. So what they're doing now, they're talking about, well, since we're starting to recover and we're happy at the progress we've made, we're going to purchase a little bit less. So instead of doing 80 and 40 billion every month, maybe it's 70 and 30 or 60 and 20. That is still an accommodative policy. That is still injecting liquidity into the system that can be used to lend or invest in risk assets.
That's exactly right. So that means that there's still reason to stick with your portfolio, but there's no question that more liquidity, it's got to go somewhere. That investment is being made either on the bond side or the stock side. So this week we saw the equities market certainly did like what they saw. And that is on the heels of a great earnings season.
Right. Earnings season was the best I've seen in my career. We saw over 90% earnings growth, over 25% revenue growth in the second quarter. Of course, that's against an economy that was basically closed. But the forecast for the third quarter continued to be very strong as the fourth quarter. And in addition, the economy is continuing to do well. So with 6% GDP in the forecast for the third quarter, it's not hard to imagine that corporate profits will continue to grow.
And so let's think about that for a second. If companies are making more stuff and then they're paying their expenses and their net income is higher, that does demand higher prices in stocks. And right now we are obviously seeing that. We see so many people that there's a backlog. There is such a demand for their product that they're making more money. That means profitability outlook going forward is still positive.
It absolutely is. In fact, right now is when the time strategists begin to forecast 2022 earnings. And they missed the boat this year. I mean, the big reason, in my opinion, the market has done so well this year is at the beginning of the year, the analysts thought that earnings would grow at a certain rate. Well, they've been dramatically exceeded. And they also thought that interest rates would go up, which they have not. So the valuation argument for equities just got more compelling as the year has gone on.
If you're new to the show, please go to annexwealth.com to learn more about what we do, why we do it. And there's certainly a big reason why we say know the difference between financial advisors.